So, good morning. You are to check now the dividend policy. I've given you some notes on the dividend policy. I suspect you have the notes. Online, check whether you have the notes on the dividend policy. I gave out last time the notes on the dividend policy. Let me know whether you have those notes. Online, you confirm to me whether you have the notes on the dividend policy. So we can take some time, we see what is contained there on the dividend policy. We can go through that handout and see what is contained there. I will do the practical questions, but for the theory, I just want us to check what is there. So when you go through it, they have stated that dividends are a part of the earnings. Dividends are simply part of the earnings which are distributed to the ordinary shareholders for their investment in the company, which are distributed to the ordinary shareholders for their investment in the company. The company should consider the following factors when paying dividends. The company should consider the following factors when paying dividends. So they have stated, like now, number one, the shareholders' expectations. So you need to know what do they expect before you make a payment for the dividend. Also, restrictions imposed by creditors or debt holders. So this will include the terms and the conditions of the loan agreement, which may restrict the company from paying dividends unless its earnings exceeds a given level. They have also talked about availability of the investment opportunities and the growth rate of the firm. If there is investment opportunities, you should not pay dividend. Use that money for the expansion purpose. Then they have also talked about access to the capital market. Access to the capital markets. So firms that can easily access the debt capital because they are listed in the stock exchange, or they have assets which they can offer as security for the debt capital, can afford to pay high dividend and retain less. Then there is also profitability and liquidity, tax position of the firm, the industrial norms. There is also inflation rate in the economy, the capital structure decisions, also the legal requirements. So those are now the things we have. Then when you go to page 2, there is NB. Under NB, they have said that the shareholders should not be the ones to decide how much dividend a company should pay because of the following reasons. Number one, shareholders and the company are two separate legal entities. Number two, shareholders may not be having the technical expertise to determine how much dividend is to be paid. Number three, there are several shareholders in the firm with different expectations. Hence, they are not likely to agree on the amount of the dividend per share the company should pay. Number four, there is normally an agency relationship between shareholders and the management. Therefore, if the shareholders determine the amount of dividend per share to be paid, it will be the principal doing the work of an agent. So there are 4 key issues there under the note. They have talked about the dividend policies and the decisions include 4 critical issues. A, when should the firm pay dividends? B, how should the firm pay dividends? Then C, how much dividend per share should the firm pay? D is, why should the firm pay dividends. Then we start again. When should the firm pay dividend? There are two categories. So the firm can pay dividend twice in the course of the year, i.e. interim and final, or only final dividends, Then they are also telling us that the major question on whether to pay interim and final or final dividends alone will depend on, number one, the liquidity position of the company, number two, expectation of the shareholders, then number three, the financial requirement. That now relates to when should the firm pay dividends. They have simply indicated that it can be interim and final or simply final alone. So from your financial reporting, you normally see that information. Dividends are declared twice, either the final only or also interim and the final. Then when you check down there, I've given you how should the company pay dividends. They normally ask those questions several times. So they can pay in form of cash, bonus or script issue, stock split or reverse split, right issue, and share repurchase. So when you check under N, they have said that cash payment, you can pay dividend in form of cash. So this is the most common form of dividend payment, and it depends on, number one, liquidity position of the company. Number two, the company's financial requirements. Those will be some of the issues we normally consider. Then when you go to the next page, there is bonus or script issue. So that one, it is simply involves giving free shares to the existing shareholders instead of the cash dividend. So instead of paying them cash dividend, now you give them shares. That's what we refer to as the bonus or script issue. I've also given you the advantages for that. Then there is the stock split or reverse split. You go through them. There is also the share repurchase. Those are now the forms of paying dividend. Those are now the forms that a company can pay dividend. Then my concern now is that dividend policies. There is something they have given you down there as dividend policies. When it comes to the dividend policies, they are saying that there are 4 major dividend policies that can be followed by the firm. These are a constant amount of dividend per share. So under this policy, a company will pay a fixed amount per annum per share, regardless of the fluctuations in its profits. So dividends are increased only after an increase in the earnings appear clearly sustainable and relatively permanent. So the following graph can show this policy. That's now the one for the constant amount of dividend per share, then being constant payout ratio. So under this policy, the firm will pay a fixed dividend rate, e.g. 10% of the earnings. The dividend per share will therefore fluctuate as the earnings per share changes. This policy can be shown in the following graph. So that's now when it is constant payout ratio. There is also C, constant dividend per share plus the extras. Constant dividend per share plus the extras. So that one, they have said this is a compromise between the two policies discussed above. It gives the firm flexibility to increase dividends during the years of high earnings. The extra dividend is given to the shareholders in such a way that they don't perceive it as a commitment on the part of the company to continue this extra dividend in the future. This policy can be shown as follows. So they have given the details for that. Then residual dividend policy. So under this policy, dividend is paid out of the earnings left over after investment decisions have been financed. Dividend will only be paid if there is no profitable investment opportunities available. This policy is consistent with the shareholders' wealth maximization goal. So I want us to do that next illustration. They have given you an example there. So that example, I want us to go through it to see how we can use it to pay dividends. So that illustration reads that the management of Viwanda Limited is in the process of evaluating the company's dividend policy. So the following information is provided. Note number 1, the company paid shillings 1.2 million as dividends in the last financial year. Note number 2, the profit after tax in the last financial year was 3.6. Note number 3, they have said that the company has not issued any preference shares. Note number 4, earnings growth rate has been consistent at 10% per annum for the last 10 years. For the last 10 years. They have also said that note number 5, the expected profit after tax for the current financial year is 4.8 million. Then note number 6, the company anticipates investment opportunities worth shillings 1.4 million in the current financial year. Then finally, the company's optimal capital structure is 60% equity and 40% debt. So now required, determine the optimal total dividends for the current financial year. If the company wishes to adopt each of the following independent dividend policy. So we start with M, pure residual dividend policy. A is pure residual dividend policy. So let us check for that pure residual dividend policy. Let us check that pure residual dividend policy. So someone was asking for the handout to be shared. Has it been shared to the class group? Has the handout been shared to the class group? Okay. So let us now go through that part A, the pure residual dividend policy. We want to know the maximum dividend to pay if the firm adopts the pure residual dividend policy. So if we adopt the pure residual dividend policy, so that part A is simply, when you check part A, it is pure residual dividend policy. So the one for the pure residual dividend policy. When it comes to that policy, we only pay dividends after we have financed all available investment opportunities. So what do? You start with the current profits. Current profits are there in the note number 5. Expected profit after tax for the current financial year is 4.8 million. So we start with expected profit for the current year, or simply the profit for the current financial year. Profit for the current financial year. Current financial year. We start with profit for the current financial year. In the note number 5, they have given you 4.8 million. Yes. I've given them out. Don't know the extra. So when you check through that note, you will be able to see what was provided there. What they were able to give you in the note number 5, is the expected profit after tax for the current financial year. So we need to minus investment opportunities, which is there in the note number 7. So number 6. This the company anticipated investment opportunities worth how much? 1.4. But out of the 1.4, go to the note number 7. The company optimal capital structure, 60% equity and 40% debt. So 40% will be borrowed, but 60% is what will come from the current profit. So in the note number 5, the profit for the current financial year has been given as 4.8 million. The profit for the current financial year has been given as 4.8 million. So we less investment opportunities from that figure. We minus investment opportunities. So investment opportunity is given to you in the note number 6. The company anticipates investment opportunity worth 1.4 million in the current financial year. But we shall apportion it because out of the 1.4, 60% should come from equity. Then 40% must come from the debt. So this profit finally will be equity. It will be the retained earnings. So our investment opportunity will be 60% of the 1.4 million. Because we only take the one which should come from the retained earnings. 40% of the 1.4 will be borrowed. So what do we get at that point? 60% of 1.4 million. We get 0.84. So we get 0.84 million. So when you minus, that's now what will give you maximum dividend to pay. Maximum dividends to pay. Maximum dividends to pay. That's now when we adopt the pure residual policy. So finally, we are getting 3.96. So that should be our part A. When you adopt the pure residual policy, you simply take the current profits, you subtract investment opportunity. But investment opportunity as per the note number 7, 60% is the one from equity. That's why I took 60% of that figure. The 40% of this figure must be borrowed because it is a debt. So equity, this current profit will finally be retained earnings. That's why we refer to it as equity. So the 40% will come from a loan, but 60% will come from equity. That's why I get 60% of that is what will come from the 4.8. But the remaining 40% will be what? Will be borrowed. That's now when we adopt the pure residual dividend policy. We now go to B. B is constant payout ratio policy. The constant payout ratio policy. Constant payout ratio policy. Constant payout ratio policy. Also have constant payout ratio policy. So this one we need to calculate the dividend payout ratio. We need first to calculate the dividend payout ratio. Dividend payout ratio. So dividend payout ratio, it is supposed to be given by the last dividend paid, the last dividend paid, the last dividend paid, divide by the previous period, divide by the previous period earnings, the previous period earnings. So when you want to get the dividend payout ratio, simply come up with the last dividend paid. We divide by the previous period earnings. So when you go to the note number 1, when you check the note number 1, they have said dividend paid in the last financial year. How much is that dividend was paid in the last financial year? It is 1.2 million. Then when you go to the note number 2, what was there as the profit after tax for the last financial year? It is given as 3.6 million. So we want to use it as a fraction. We present it in form of a fraction. So 1.2 million can go to itself once. It can go to itself once. 1.2 million can go to 3.6 3 times. So finally, it will be 1/3. I'm saying 1/3 because it will be a fraction. It has some decimal point. So that we use the exact value. So now once you get the dividend payout ratio, we can now compute the maximum dividend to pay. Maximum dividends to pay. Maximum dividend to pay will be equal to the maximum dividend to pay will be equal to dividend payout ratio, dividend payout ratio multiplied by the current earnings, multiplied by the current earnings. So our dividend payout ratio is 1/3. We have just calculated. Then if you confirm in the note number 5, the question had given you expected profit after tax for the current financial year, which was 4.8 million. So that should be able to give us maximum dividend to pay when we adopt the constant payout ratio policy. That's now giving you the maximum dividend to pay. You simply take the dividend payout ratio, which we have calculated, the now multiplied by the current earnings, which is there in the note number 5. So that's now on that portion. So how much is it? 1 point. Yeah. So that is now when you adopt the constant payout. So number C is stable, predictable dividend policy. Stable, predictable dividend policy, whereby the growth rate being equivalent to the earnings growth rate. So when we adopt stable, predictable dividend policy, when we adopt stable, predictable dividend policy, when we adopt stable, predictable dividend policy. This is now the one for the stable, predictable dividend policy. So stable, predictable dividend policy. Dividend policy. This one is ours. So when we adopt stable, predictable dividend policy, D1 is normally given by DO1 plus G. So you have all come across that formula. If you want to know the next dividend to be paid, you take what was paid last, increase it by the constant growth rate. So in the note number 1, you are given dividend that was paid last. So in the note number 1, the last dividend paid was 1.2 million. 1.2 million. Then 1 plus the constant growth rate. The constant growth rate was there in the note number 4. So the earnings growth rate has been consistent at 20% for the last 10 years, 10%. But when you go under that part C, you see stable, predictable dividend policy, the growth rate being equivalent to what? The earnings growth rate. So that earnings growth rate is 10%. So G is 10%. So it is the same as 0.1 like that. So that now will give you the maximum dividend to pay when you adopt the stable, predictable dividend policy. You simply take what was paid last year, increase it by the constant dividend growth rate. Increase it by the constant dividend growth rate. So that should be our part C, stable, predictable dividend policy. So we go to D, regular plus extra dividend policy. Regular plus extra dividend policy. Regular plus extra dividend policy. So regular plus extra dividend policy. So for this one, maximum dividends will be equal to the regular dividends, then add the extra dividends. We add the extra dividends. So maximum dividends should be equal to the regular plus the extra dividends. So let us see how to get the extra dividends. The extra dividends. We check how we can be able to compute the extra dividends. So to get the extra dividends, we start with the current earnings. We start off with the current earnings. So current earnings were there in the note number 5. It was 4.8 million. Current earnings was 4.8 million. Then you less investment opportunities. We minus investment opportunities. So investment opportunities, you remember 60% of 1.8 million. 60% of 1.8 million. So this one I've given us which here? It was 0.84. Then we also less regular dividends. We also minus the regular dividends. So regular dividends are the same as the one for the stable, predictable dividend policy. Regular dividends are the same as the one for the stable, predictable dividend policy. So remember this figure, you said it was how much? 1.32. So stable, predictable dividend policy is what normally gives you the regular dividends, because it has been constant for the last 10 years at 10%. So that is the same as our regular dividend. It is 1.32. So when you minus these two items, you will now get the extra dividends. We shall come up with the extra dividends. Should be able to get the extra dividends. Which is supposed to give us how much? 2.64. So now from there, we should now calculate what should be this maximum dividend to pay. So maximum dividend to pay regular is 1.32. 1.32. Then add 2.6. So now to get maximum dividends to pay. Maximum dividends to pay. Regular is 1.32. Then you add 2.64. So there is a question in your past papers about that. There is a question in your past papers in relation to that. So let us go through September 2021. September 2021, question number 2, part A. So check September 2021. September 2021, question number 2, part A. September 2021, question number 2, part A. You check September 2021, question number 2, part A. So are we able to see that question? September 2021, question number 2, part A. So we can go through that question for September 2021, question number 2, part A. September 2021. So the question reads that Maridadi Limited is a firm earnings, is a firm that operates in the textile industry. A firm that operates in the textile industry. So the firm's operating profit, and that is earnings before interest and tax over the next 5 years are forecasted as follows. They are forecasted as follows. So they gave you the year from the year 2021 to 2025. So additional information, note number 1, the firm expects to incur fixed financing costs of shillings 20 million in the year 2021. This is expected to rise at a constant rate of 10% each year. Then note number 2, the firm's acceptable investments to be financed each year are given as follows. So they gave you the year from 2021 to 2025. Acceptable project is given. Corporation tax rate is also given. Number of issued ordinary share is also given. So these are expected to remain constant each year. Then required dividend per share payable each year, assuming the firm adopts 40% payout ratio as it is dividend policy. So here they have calculated for you. This question, remember 1/5, 1/3. Yeah, this one, the one which is Roman letter 2. You can see part B of the previous question when you adopt the constant dividend payout ratio. But here they have given you the payout ratio as 14%. Roman letter 2, dividend per share payable each year, assuming the firm adopts which policy? Residual dividend policy. We have done that in the first one. When it comes to the residual policy, we only pay dividend if all available financing options have been financed. So we start by preparing the cash flow statement because we have not been given the profit for the current financial year. So we start by preparing the income statement in order to get the profit, the income statement. So we need to prepare the income statement first. So before we go to the Roman letter 1, we prepare the income statement. We prepare the income statement. So there is 2021, 2021, 2022, 2023, 2024, 2025. So I reduce them by the 3 figures. I reduce them by So the question gave you operating profits, which is the same as earnings before interest and tax. Operating profits was given earnings before interest and the tax. So 2021, they gave you 10 millions. 2022 is 12 millions. 2023 is 15 millions. Then 2024 is 16 millions. And also 18 millions. So that is earnings before interest and tax. We need to less interest. We need to minus interest. So interest is what you are given in the note number 2. You check note 2, where they have said that the firm's estimated fixed. When you check the note number 2, they have said that the firm's not note number 2, but note number 1. The firm expects to incur fixed financing cost of how much? Yeah, so that 20 million is not realistic. You change it to 2 millions. Because these figures, none of them is above. So that 20 million is not real. So I want us to change it to 2 million for us to be practical. Because our operating profits, none of them is above 20 million. Then when they continued on the same, they said that it will increase by what percent? 10%. So which now becomes more abnormal. So that figure should have been 2 million. It should have been. So fixed financing cost is the same as the interest. The fixed financing cost is the same as the interest. So let us now subtract that interest. Less interest. Less interest. So 2021, it will be 2 million. But 2022, it has increased by 10%. When we increase 2 million by 10%, it will be 2.2. So 2022 will be 2.2. It is increasing by 10%. Also increase the 2.2 by 10% to get the one for 2023. Also increase the same figure by 10% to get the one for 2024. 2662. Also increase the same by 10% to get the year 2025. Sorry? Exactly. So now you subtract that interest so that you get earnings before the tax. So that you get the earnings before the tax. So this one will be 8. Here next is acquire 11 or sorry, it's acquire 9. Then here next itakuwa which figure? Then 2024. That's 38.
Yes.
How about 2025? And after that? Like that. And now we less the tax. Now we less the tax. Minus the tax. So tax should be 30% of those figures. So what should be 30% of 8? This should be 2400. 30% of 98. 2940. And also 30% of 12,580. 37. Also 30% of 13,338.
You also come here. You also come here. So research.
What is the one?
4001. Like that. And the one for 2025.
Research is already
45.
then advertising
55. So now come up with the earnings after the tax. We now get earnings after the tax. This one is 56. Exactly 56. Na hiyo next inakuja ngapi? 60. And 2023 should be 88.06. How about 2024? 93. Then 2025. 10. So if there were preference shares, you could have subtracted the preference dividends. We could have subtracted the preference dividends. If there were preference shares, we could have subtracted what? The preference dividends. But the question had no that figure. So it is just a dash like that. So that we end up getting earnings available. We end up getting the earnings available. So that we end up getting the earnings available. So this one will be 56. This will be 6860, 8806. 9336.6 and 10. But if there were preference dividends, then you could have done what? Yeah. So the question now we get the dividends to be paid. Dividends to be paid. So the question, we are now on the Roman letter 1. This one is now the Roman letter 1. You want to get the dividend to be paid. Roman letter 1, they gave you the dividend payout ratio. You can see our dividend payout ratio. It is what percent? Yeah, so get 40% of those earnings available. So this will be 40% of 56. So you get 40% of 56. Like that. This one will also be 40% of 68, 60. Get the value of it. Also, this one will be 40% of 88.06. Also 40% of 93.36.6. Like that. Also 40% of 10. So they also wanted per share. You see the question wanted per share. So you can see that from letter 1. They wanted you to get the dividend per share payable each year, assuming the firm adopts 40% payout ratio as it is dividend policy. Note number 4 has given you the number of the ordinary shares as 10 million. So to get the dividend per share, divide each by 10 million. So I have 3 zeros at the top, divide by 10,000. We divide by the number of the ordinary shares. The number of the ordinary shares are given to you in the note number 4. But we have 3 zeros at the top. So divide each by 10,000. We divide each by 10,000. We divide each by 10,000. Divide each by 10,000. Divide each by 10,000. So to get the dividend per share, so divide by 10,000 each.
wanafundisha 6 months kama
Sí,
mchango.
sasa hiyo unless they buy some time, let's stick to this one. Always we are not always within the year.
The argument was watu wameanguka sana.
Oh, do they? That's or probably just change everything, maybe like calculation of time for 4 months. See the expense then they agree. Because these are
So that's now when you adopt the constant payout ratio. So we go to the Roman letter 2. Roman letter 2 is when you adopt the dividend per share payable in each year, assuming the firm adopts the residual dividend policy. Let us now apply the residual dividend policy. Roman letter 2. Roman letter 2 is when we apply the pure residual policy. So Roman letter 2 is the one for the pure residual policy. So when we use the pure residual policy, we shall start again with the earnings available. We start again with the earnings available. We start off with earnings available. So in the year 2021, remember it was 56. These ones that we had calculated. So this one was 68, 16, 8, 06, 93, 36, 6. This one was 10 by 50.26. So now we list investment opportunities. When we use the pure residual policy, once you get that figure, we minus the investment opportunities. Investment opportunities were given to you in the note number 2. You can see the note number 2. They have stated that the firm's acceptable investment to the financed each year are given as follows. So we minus the investment opportunities to get now the maximum dividend to pay. When you are using the pure residual policy, simply take what is there as earnings available. Then you minus the investment. Once you subtract the investment, the balance will be now the dividend to be paid. So we less the investments. We less investments. We minus the investments. So they gave us in the note number 2. The first one is 3 million. There are 3 zeros. The second one is 45. The third one is 5. Then the next one is 65. finally 7.
1% of 165.
So when you subtract, that now will give you the dividends to be paid. The balance should now be dividends to be paid. So this one should be 26. The next one should be 21. 2360. This one should be that much. Then the next one should be 23, 28, 36.6. Then the last one should be what? 35, 50. So once we get that, remember they wanted per share. They wanted dividend per share. So divide by the number of the ordinary shares. Divide by the number of the ordinary shares. So that you get per share. The question wanted per share. So dividend per share on the basis of that. So this will be 26. There were 10,000 or 10 million ordinary shares. There are 3 zeros at the top. So just divide by the number of the ordinary share for each. So this one will be 2360. Also divide by 10,000. This is 3826. Also divide by 10,000. 2836, also divide by 10,000, also 35, 50.26, also divide by 10,000. So the number of the ordinary shares were given as 10 million, but now that we have 3 zeros at the top, we apply it from that portion. So that's the only question I can see in your past papers on the dividend policies. On the dividend policies. There are basically 4 of them. We have already seen them in the notes. And that's the only question that was tested. But I also did an example in class on that, from that handout. So let us go back to your handout. Let us go back to your handout. Now we are on page 6. We now go through what is there on page 6. So page 6 is all about dividend theories. Page 6 is all about the dividend theories. So when it comes to the dividend theories, they have said that there are several theories which try to look at the relevance or irrelevance of the dividend payment. So we shall discuss some of those theories. So the first one is dividend irrelevance theory. The first one is dividend irrelevance theory. So when you look at that dividend irrelevance theory, it says that this theory was proposed by Franco Modigliani. Franco Modigliani and Morton what? Miller. It was proposed by Franco Modigliani and Morton Miller. That's why it is known as It is known as because it was proposed by Franco Modigliani and Morton Miller. So you can see that part. That's why it is known as because of Modigliani and Miller on the other side. So in 1961, who argued that the value of the firm is determined by basic earnings power and the firm's risk and not by the distribution of the earnings. So they continue to say that the value of the firm therefore depends on the investment decisions, but not the dividend decisions, but not the dividend decisions. So they also gave the argument. Their argument was, however, based on the following assumptions. You see, number A, no corporate or personal taxes. B, no transaction cost. C, the firm's investment policy is independent of what? The dividend. So the market is efficient. So those assumptions are the same as weaknesses or limitations. Assumptions are normally the same as the weaknesses or limitations. So I want you to go to the last sitting. I want you to check the question on the last sitting. That is April 2022. Go to April 2022, question number 1, part B. Check April 2022, question number 1, part B. When you check through the sitting of April 2022, question number 1, part B. So they have stated that state 5 arguments against Modigliani and Miller view that dividend policy is irrelevant as a means of affecting the shareholders' wealth. So those arguments are the assumption. In the notes, they are supposed to be 5. You see in the notes, that number 1 should be divided into 2. You see A, you divide it into 2. A should be no corporate taxes, then B, no personal taxes. So you separate it into 2 to make them to be 5. So A should be no corporate taxes, B, no personal taxes, C, no transaction cost, D, the firm's investment policy is independent of the dividend policy. Then finally, E, the market is what? Efficient. You need to divide that into. So those arguments are those assumptions. Those arguments were meant to be those particular assumptions. There are 5 of them, but in my notes, the first 2 are combined together. So that was now what was in that model. But now when we shall be confining through some questions, they were able to argue that whether you pay dividend or you don't pay dividend, the value of the firm will remain the same. So from those arguments, there is now a practical question. I want us now to do a practical question in your past papers. I want us now to do a practical question on that. So there is a question in the sitting of December 2014. Who confirm in the sitting of December 2014? It should be May 2014. So I want you to check May 2014, question number 3. So go to May 2014, question number 3. We check May 2014. There is a question number 3, starting with part B. May 2014, question number 3, starting with part B. So part B, they were asking you to state 3 factors that the company should consider when formulating its dividend policy. Factors to consider when formulating the dividend policy. Those factors I've listed them. When you check the first page, they said the company should consider the following factors when paying dividend. Those are the factors to be considered. There are several of them. You just go through them and then you list them. The first one is shareholders' expectation, restrictions imposed by maybe the credit or debt holder. So you read those factors. Read those factors to consider when we are paying dividend. When you go to page 1, I've listed all of them. I was able to list all of them. So check it from that portion. So let us go to part C of the same question. Let us check part C. So when you go to part C, when you check part C, they are saying that Baraka Limited has a cost of equity of 10%. Baraka Limited has a cost of equity of 10%. So currently, the company has 250,000 shares. Currently, the company has 250,000 shares, which are quoted at the Securities Exchange, at links 120 per share. So the company's earnings per share is 10 shillings, and it intends to maintain dividend payout ratio of 50%. It intends to maintain dividend payout ratio of 50% at the current financial year. Then the expected net income for the current year is 3 million, and available investment proposals are estimated to cost 6 million. So required using Modigliani and Miller model show that payment of dividend does not affect the value of the firm. You want to confirm that whether you pay dividend or you don't pay dividend, the value for the firm will not change. So first, let us get the value for the firm. Let us first get the value of the firm. We shall first see how to get the value of the firm. So we want to show that payment or non-payment of dividends does not affect the value for the firm. I'm interested in that question because of what they tested last sitting. Last sitting, they tested assumptions. So mtu anaweza tena kuja the same. So one of the assumptions were tested in the last sitting. So this time he can now decide to test the practical part. That's why I'm interested in that part of the question. So we start with value of the firm. Let us first get what should be the value of the firm. So when we are using that model, value of the firm, will simply be NPO. I will explain what each one of them stands for. It will simply be NPO. NPO. Where N is the existing number of the ordinary shares. So NPO, where N is the existing number of the ordinary shares. So where N is the existing number of the ordinary shares, then PO is the current market price per share. PO is the current market price per share. So PO, it is simply current market price per share. So I want you to check in the first line. You can see in the first line, the cost of equity is 10%, but currently the company has how many shares? 250 is our N, which are quoted at the Securities Exchange at how much per share? 120. So N is 250,000 shares. So N is 250,000 shares. And the PO is 120. So multiply them together. PO is 120. That's now the value of the firm. That now we give you the value of the firm. That now should be able to give you the value of the farm. So it is giving you around how much? It is giving us 30 million. So let us now check. If no dividend is paid, what should be the value of the farm? So let us start with also, if no dividend is paid, if no dividend is paid, if no dividend is paid, what should be the value? So if no dividend is paid, it means that D1, which is the dividend at the end of the year, will be 0. So if no dividend is paid, D1, which is the dividend per share at the end of the year, will be 0. So there are 3 steps to confirm that. There will be 3 steps to determine that. So our step number 1 will be that estimate P1. So estimate P1. Our first step will be to estimate P1. Where P1 is the price per share at the end of the year. Where P1 is the price per share at the end of the year. Where P1 is the price per share at the end of the year. So to estimate that P1, we shall apply the formula that PO is supposed to be given by D1 plus P1 divided by 1 plus R. So to estimate our P1, we say that PO should be equal to D1 plus P1 divided by 1 plus R. So we are simply looking at the present value. So remember present value. What present value should be equal to the future value 1 plus R. That's the power of negative. So this future value at the end of the year would have a dividend, because we are making this one to be the subject. If we make now this one to be the subject, I'm removing the negative. So it is the same as the present value will be the future value divided by 1 plus R, but not just the power of n. So this future value are dividends and what? The price at the end of the year. So anyway, you forget about this, you want to just come up with that so that it should not bother you at that level. So you want to estimate P1. So to estimate P1, we use that formula. So PO is already given to you. You see from up there, our PO is 200 and no, not 120. So 120, but we have said that if no dividend is paid, D1 is what? Is 0. Then plus P1. P1 is what we are looking for, 1 plus R. R is the cost of equity. Are you able to see in the last line, what are you given up there as the cost of equity? 10%. So 10% is the same as 0.1. So make P1 be the subject. Make P1 be the subject. So make P1 be the subject. One. 132. We are all getting 132. So that is our step number 1, where we estimate P1. So we got the step number 2. We got the step number 2. So step 2 will be that estimate M. So our step number 2. So our step number 2. Our step 2 is that estimate. Where M, our step number 2 is the estimate M. Where M is the number of the new shares to be issued. where M is the number of the new shares to be issued, where M is the number of the new shares to be issued in order to raise the new capital, where M is the number of the new shares to be issued in order to raise the new capital, in order to raise the new capital. So where M is the number of the new shares to be issued in order to raise the new capital. So to get M, we use this formula. But MP1 should be equal to I minus X plus ND1. So I'll be explaining what each one of them stands for. So MP1 should be equal to I minus X plus ND1. So we already know M. We have said that M are the number of the new shares to be issued. Already we know P1. So you see what we have done in the step number 1. But this I is investment opportunities, where this I is the investment opportunities, where that I is investment opportunities. Then X is the net income. X is the net income. So I is the investment opportunities. So this one is investment opportunities. This is the net income. N, we already know it. So you know that N. So you have seen the N up there. So D1, you have said is written at the end of the year, which is what? 0. So go through the question. I want you to check through the question. You see investment opportunities. How much has the question given you as the investment? In the next paragraph, the expected net income for the current year is 3 million. And investment proposal are estimated to cost how much? So our I is 6 million, which is investment opportunities. Then X is the net income, where they have given us how much? 3 million. So this N, your N, it is 250,000, isn't it? Which is the same as 0.25. But D1 is 0 if no dividend is paid. D1 is 0 if no dividend is paid. So D1 is 0 if there is no dividend that is paid. So that we now come up with MP1. So what should be our MP1? Our MP1. I want first MP1. D natural it is 3 minutes like that. MP1 is 3 minutes, but we want to get M. So making M to be the subject is MP1 divided by P1. Making M to be the subject to be MP1 divided by P1. So MP1 is 3 millions. P1 we have calculated in the working number 1. You remember our step 1. What was there as M as P1? Sorry, you calculated the vote which figure? 132. Yeah, so confirm if it has some decimal point to divide to near the way it is. So confirm whether it has some decimal points. Aina? Yeah, if it has, don't divide. We shall use it the way it is, where we require it. Where we require it to because we are simply confirming that whether you pay or you don't pay dividends, the value will remain the same. So that's now our step number 2, estimate M. Finally, the step number 3. Finally, the step number 3, estimate the value of the farm. So step number 3 is that estimate the value of the farm. Step number 3. Finally, step number 3 is that. So our step 3 We want to estimate value of the farm. Value of the farm. So to estimate the value for the farm, we use this formula that P1 in the brackets of N plus M, we minus I, then we add X. We divide by 1 plus I. So now we can have it. All this we have discussed, but we are only making them together to get the value for the farm. Get the value for the farm. So now our value for the farm, we apply that part. So you already know P1. P1 in the completion ngapi? 1, 2. N, we know it. Remember, you know N? It was 200 and what? 250,000. So M, we have said that we use it the way it is. It was 3 million divided by what? So 3 millions divided by 1, by 2. Then you minus I. I is investment opportunities, which is 6 millions. Then we add net income, which is 3 millions. You have seen that here. Then now you divide by 1 plus R. R is the cost of equity 10%, which is the same as 0.1. So I want you to calculate that here and see what value are we coming up with. So give me the figure that you have calculated. Online, you are getting which figure? Online, when you compute, what value are you coming up with? No one has given it, so they are saying 30 million. Yeah, that is how we confirm that even if you don't pay dividends, your value will still come to 30 million. We already have the value. We are only confirming that whether you pay or you don't pay, value will remain the same. Now we have not paid, the value is still the same. Let us now also confirm if dividend is paid. Let us now check if dividend is paid, whether it will remain the same. We also want now to confirm if dividend is paid, whether the value will remain the same. We want now to confirm if dividend is paid, will the value remain the same? So this is now if dividend is paid. If dividend is paid. So if we pay dividend, will the value remain the same? So first we check that dividend per share is supposed to be given by earnings per share multiplied by the dividend payout ratio multiplied by dividend payout ratio multiplied by payout ratio. To get the dividend per share, simply take earnings per share. So the question has given us the earnings per share. That question has given you the earnings per share. So are you able to see the earnings per share in that paragraph? Yeah, so the company's earning per share is given as 10. So it's given as 10. Then dividend payout ratio is what percent? So what is 50% of 10? We get 5. So you come up here, you see that now dividend in year 1 will be 5. So if dividend is paid, D1 will be what? 5. D1 is going to be 5. We start again with the step number 1. We now start again with the step number 1. You can see our step 1. What are we supposed to estimate in step 1? Yeah, so we estimate P1, which is the price per share at the end of the year. So let us now estimate our step number 1. So step 1 is that estimate. Estimate P1. So to get P1, the formula is that PO should be equal to D1 plus P1 divided by 1 plus R. And our PO, we know it is 100 and what? So it is 120. Now D1 is 5. P1, we don't know it. Then remember our R is the cost of capital, which was 10%. So make P1 to be the same and see what value are we going to come up with. After that, 127. So we got the step number 2. Remember step 2? Now we just follow the order, the way you have done the other part. So we got the step number 2, where we estimate M. We now got the step number 2 to estimate M. We got the step number 2, where now we estimate M. Where we estimate M. So our step number 2, we estimate M. So to get M, we use the formula that MP1 should be equal to I minus X plus N1. So I, we know it is how much? It's 6 million. X, it is 3 million. So N is 0.25. 250,000 is the same as 0.25. Then D1 is 5. So that should now be able to give us what is supposed to be MP1. So inakuja ngapi? 4.25. So to get M, this MP1 divided by P1. So this would be 4.25 million. Was it 132? How much 127. Yeah, so again, we say that in case it has some decimal points we don't divide, we shall use it directly. So we got the step number 3. Now got the step number 3. So step 3 is supposed to be estimate the value of the farm. The step number 3 is meant to be that estimate the value of the farm. So the step number 3 is that estimate the value of the farm. So we got the step number 3, where we estimate the value of the farm. So step 3, estimate to get the value for the firm, I gave it the formula that P1 in the brackets of N plus M minus I plus X 1 plus R. So P1 is 127, N is 250,000. Also add 4.25 divided by 127 minus 6 millions. 3 millions. Then also divide by 1 plus 0.1. So confirm whether you still get the same figure. So now you want to confirm whether you are still going to get the same value. You are getting 30 millions. Yeah, so whether you pay or you don't pay dividend, the value will not change. That is the argument by M and M. It is the argument by M and M. So now we can make a conclusion on that part. We can now make a conclusion. Therefore, payment or non-payment of dividends. Therefore, payment or non-payment of the dividends will not affect the value of the firm. Therefore, payment or non-payment of the dividends will not affect the value of the firm. So whether you pay or so, the accurate part starts by NPO. You see NPO? From there, anything you do, you must get what you got there as NPO. That is now how it should be. So there is another question, but this one is a theory question. I want us just to see what is contained there. There is also a theory question. There is also a theory question. So check May 2019, question number 1, part A. May 2019, question number 1, part A. May 2019. It's just a theory question. It is not practical. So I want you to check May 2019, question number 3, part A. So that May 2019 question, so not 3, but question 1, part A. May 2019, question 1, part A. May 2019, question 1, part A. So that question 1, part A, they have said that explain the following dividend theories. Explain the following dividend theories. There is information signaling, tax differential theory, then bird in hand theory, also the agency theory. So I've summarized all of them. You see in the notes, after M and M, in the handout, M and M is number 1. Then there is number 2. You see number 2? Number 2 is the bird in hand theory. Number 2 is the bird in hand theory. So under the bird in hand theory, they have said that this theory was developed by Martin Gordon and John Lintner in 1963, who argued that a bird in hand is worthy 2 birds in the bush, and thus when the shareholders receive cash dividend, he is better off than receiving the capital gain. Is better off receiving the capital gain. So capital gain is whereby you are given a share so that it appreciates at the end of the year to get the gain. But now for the dividend policy, they pay you cash. So that is what they refer to as the bird in hand. So they say that investors therefore value dividend more than the capital what? Gains. And a firm that pays dividend will have higher market value. They concluded that dividend decisions are what? Relevant, and the firm that pays high dividend has a higher value. That's now the bird in hand theory. It is better you receive your cash today rather than someone giving you the share to get the returns at the end of the year. You see that question? Yeah, so that's what we mean by bird in hand. You are paid cash dividend instead of waiting at the end of the year to be given the capital gain. Then, are you able to see number 3, the tax differential theory? It is also one of them they wanted you to explain. Number 2 there is the tax differential theory. So this theory was advanced by in 1979, who noted that the tax rate on the dividend is higher than the rate on capital gain. So in the Kenya, capital gain tax has been exempted, suspended from tax. So a firm that pays dividend will therefore have a lower value since shareholders will pay tax on this dividend. Dividend decisions are relevant, and the firm that pays no dividend has a higher value. Then when you still check there is now the information signaling theory as number 1. So under the signaling theory, Stephen Ross in 1977 argued that in an inefficient market, management can use dividend payment to signal important information to the market, which is only known to them. If the management increase dividend, it signals that expected higher profit, and therefore the share price will do what? Will increase. Therefore, dividend decisions are relevant. So that's now the information signaling theory. Just pay dividend. People assume that now when you pay dividend, the company is stable, but probably that is not the case. Then, kuna hiyo number 5, clientele effect theory. So they normally also ask on the same. So the theory was proposed by Petit in 1977, who stated that there are different groups of shareholders who have different preference for the dividend. So that theory divides investors into 2. Those who want to be paid dividend and those who want to be paid capital gain. That's now what we have on that portion. So I want you to read that. You see now, that part, they were simply testing the theory part. The agency theory, even the agency theory is there. You see number 6. Number 6 on the handout is the agency theory. So I would like you to get time, you go through that handout. It has some notes or some information which can be important for you for the exam. So kuna something remaining, then kuna notes in your pairs are working capital management. Unakumbuka? Yeah, so I wanted us to meet tomorrow from 10. I want us to meet tomorrow from 10. We finished 2 questions on the dividend policy. Then we now start that management on the working capital. If we don't finish, our class is normally on Tuesday, isn't it? So to pattern it on Tuesday. Those who will not be able to come tomorrow, I cannot be able to make it earlier because I already have another class which will start at 6. Yeah. I already have another class which will start from 6. Yeah, today in the afternoon, I have another class. So the only time I've reserved for you tutapatana kesho from 10 up to 1. If we don't finish, I will also meet you in our normal class on Tuesday. We conclude on that. Yeah, this other time when I mentioned, sit down somewhere, read. Yeah, the time you are mentioning, sit somewhere and read. Kesho from 4 p.m. I will be preparing myself for the next class on Monday. I cannot be away from my family on Saturday, Sunday, Sakumi. I cannot be away from my home. So the time I've given you, kindly reschedule. I will also be recording. Those who not be available to be available that time, I will be able to record it, but get some time because I'm finalizing. We are finalizing on that portion. Yeah. I've only given you 2 items. Then after that, everyone will be free. So is it clear those who are online? Yeah. Kesho tupatane hiyo time. Yeah. So let us stop there for now.